I want to introduce our first speaker, Brad Blazar. He's a raising capital expert. He's raised $2 billion in capital. He's an author of 3 books. Coach. He's one of my personal coach, and he's going to talk about how he raised millions of dollars through events. So I will welcome Brad Blazar to the High Performance Summit.
Great. Well, first of all, thank you everybody for listening to this and showing up, holding yourself accountable. As Jason said, my name is Brad Blazar, known globally around the world as the $2 billion guy. And it's largely because I've raised over $2 billion in high net worth investor capital through my efforts and largely through the efforts of teams I've led as the national sales director or as the president of certain capital teams. And today, I want to talk about something that I'm very passionate about, and that is teaching entrepreneurs and business owners how to attract, how to raise, and how to close investor capital. Because every business needs access to money. You need it either to buy a business, you need it to grow your business, you need it to make acquisitions, or you might need money just to basically invest in a special project, something like real estate. And before I get started, what I'd like you to do is just kind of close your eyes and imagine what your life would be like if over the next 6 or 9 months, I could teach you how to raise $250,000 or $500,000. You see, I think the problem a lot of people have when it comes to thinking about raising money is they start off with these big, bold ambitions. Like, I want to launch a fund and I want to raise $10 million, or I want to do something like buy a big apartment building and raise, $15 million. And for most people getting started, they think that, but then when they look at what's required to do that, they immediately give up, because the goal and the dream appears so big and so unattainable. And so today, what I want to try to do is I want to try to break it down into what I call baby steps. Let's take some baby steps. Let me show you how to raise your first 50,000. Okay, now imagine $50,000 doesn't sound like a whole lot of money, but it is. Because if somebody can give you $50,000 as a potential partner or as an investor, you can now use that money to do something with it. Maybe you buy a small rental property, you go in, you rehab it, you make it look real nice, you rent it out. Maybe you're generating a couple $100 a month in positive cash flow. You're collecting some tax benefits. But most importantly, that piece of real estate is increasing in value. It's building your net worth. It's building the investor's net worth. And then let's say maybe 3 years from now, you sell that and the property has appreciated in value enough where after you give the investment his capital back, you're able to walk away with maybe 30, 40, maybe $60,000. How would that change things for you? Would it allow you to pay some bills? Would it allow you to take a nice vacation, do something special with your family? Let's take that same 50,000. Maybe you can go in and rehab and flip a house rather than just renting it out. And on the back end, when you flip it, and you make 60, 70, $80,000. You give the investor their money back. And again, you make $30, $40,000. You see, folks, once you learn this process, you can repeat it over and over and over again, much like I have, to go from raising 50 to now a few 100,000, then to potentially millions. So let's break this down into small baby steps. And on today's session, what I want to really do is I want to help you better understand how to approach raising money from investors. I want to give you a little bit of a head start, as well as some tools that you can use to begin approaching investors very quickly. And then I also want to uncover with you many of the mistakes that I see people make when they're trying to raise capital. And, after speaking with many entrepreneurs and business owners all over the world, because we currently coach people in the United Kingdom, in Australia, in New Zealand, here in the United States, of course, Canada. I find that one of the biggest things they want to learn how to do is raise money. But I also understand how frustrating and how overwhelming it can be trying to raise investor capital, because just when you think you finally have it figured out, that one person, that one investor that you thought would commit says no, thank you. And then it's back to the drawing board once again. And there's usually a reason that that person that was very nice to you, that asked you to send the material so they could take a look at it, says no, thank you. And it's usually because you acted too quickly and you pitched or you presented the opportunity too early in the process before you established trust. You remember yesterday, I talked about the trust sequence, right? These are 6 things that need to happen sequentially to build that trust and build that relationship within another person. It starts with perception. What's that introduction look like? Then you have to move to temptation, uncovering the things that are going to allow that person to invest. They're going to tell you certain things as you ask questions that'll help you uncover the reason that they want to invest with you. Then it goes to connection, right? For those of you that were listening, what was number 4? One of the most important, validation, validating that that trust exists. Then we went to attachment, where they're physically investing. And then we get to the last step, which is affiliation. So today, I want to give you a lot of tools so that you can go from where you are, which is maybe raising no money, to where you want to go in as little time as possible. And I call this the going further faster method. And it all really centers around leverage. You see, most people think that growth happens 2 ways: time or money. Let me say that again. Most people think that growth happens 2 ways: either time or money. And what I want you to do is I want you to think about the parable, the tortoise and the hare. Y'all know the story about the tortoise and the hare? You see, everyone has the same 24 hours in a day. How are you spending yours? Because over time, if you make the right decisions in your business and you use your time wisely, you plan for success, you will win by default. Okay, you will win because money has an immediate growth effect. Think of it like dumping jet fuel into a race car. If you don't have every facet of your business ready to go fast, an injection of money can quite literally break your business. And while there's other ways you can grow, one of the other things you can do is leverage. So I want to talk to you today about some things I know about raising capital from investors so that you can have what I call that maximum leverage and begin having success immediately. You know, if you have a business and you're just getting by, your business is just basically, maintaining what I call status quo, an injection of capital can really then catapult you to a whole nother level of success. Why? Because you can use that money for marketing. You can use that money to hire people. You can use that money to do something special, to become better known in the marketplace. So let's start off talking about basically raising money. And I want to share with you, I guess, what I call the good news and the bad news. The good news is that now is an incredible time for startups and for business owners to connect with investors that share their vision, because the internet has created and continues to be one of the best ways to attract and reach out to investors. You see, after the government passed the Jobs Act in April of 2012 and the subsequent rise of crowdfunding, what they did is they loosened the restrictions, basically forging the way for business owners and entrepreneurs to get into investor wallets. The bad news, well, not so much really the bad news, is it takes time. It takes effort. It's a grueling, time-consuming, and at times a frustrating process. Because if investments were made in companies based on merit alone, the world would be a whole different place than it is now. But the fact of the matter is that there's a lot of other factors that go into investor decisions. to either invest or not to invest. Okay, I personally myself have heard a number of the original sharks on the hit TV show Shark Tank. I know Kevin Harrington. I've got him in my cell phone. He was one of my speakers at Capitol Con this year. I've heard Kevin O'Leary speak multiple times on how he invests. Damon John, been in Damon's office in New York. And what I've learned is investors do not invest in ideas. Okay, let me say that again. Investors do not invest in ideas. You can have the greatest idea on planet Earth, take it to a group of investors, and still not get funded. And you're like, man, this is such a great idea. No, see, investors invest in great ideas that are backed by people that can execute. If you can't prove to investors that you can execute on a strategy, good luck. So, the purpose of the investor discussion today is really for me to demystify a lot of this and help you, the business owner, the entrepreneur, the CEO, get into the best possible position to get the capital, to get the investments, get the things that you need in order to have success. So, let's get started. A good fundraising effort requires that before you even get started, you have great supporting documents. Okay. Think of you sitting in front of a prospect or a potential investment partner. Okay. One of the things that you need to do before you ever get there is basically have what I call an investor package, kind of an investor kit that you're going to be capable of presenting. And so I want to share with you a comprehensive list of what you need to kind of prepare before you're ever ready to initiate that money raising effort. And here's the great thing. If you don't know how to put these together, if you don't know how to go ahead and create a pitch deck, if you don't know how to, for example, to put together your PPM, we'll largely teach you how to do this. So let's talk about your elevator pitch. Okay. Your elevator pitch is a very short, a very consistent synopsis of your business, usually expressed in just a few sentences. Think of it like your explanation of service. And perhaps surprisingly, getting this pitch down to a very short, very concise delivery can sometimes, for a lot of people, be pretty difficult because you want to expound and you want to tell people like what you are all about, like what does your business do, like why is this such a great opportunity. But in reality, you want to keep this short. The amount of content that you have in what I call your elevator pitch should be no more than just a few sentences. The amount that goes into this elevator pitch needs to be extraordinary, but a good elevator pitch delivers and conveys a few things very quickly. It's the problem you solve, the solution that you provide, and more importantly, the people that you do it for. Okay, so let me give you an example of a great elevator pitch. Okay, we allow anyone to easily get a ride from their cell phone. Man, now most of you that just heard that can probably guess that that is a phenomenal elevator pitch that would have been very succinct and very, very effective for who? For Uber. Exactly. You see, Uber's pitch, if somebody were standing next to the founder of Uber in an elevator and he said, hey man, like what do you do? Literally in 30 seconds, we allow anybody to easily get a ride from their cell phone. Boom, that's an elevator pitch. See, and you're going to use your elevator pitch often. You're going to use it in introducing yourself and your business in emails. You're going to use it in presentations. And yes, you're actually going to use it in elevators, perhaps if you get chance meetings. You know, I ride first class on jets whenever I travel. I'm traveling this week to Orlando, Florida. Then I'm going to be jet setting over to Denver. Then I'm going to be jet setting back to Tampa before coming home. And for the major portion of that trip, I'm in first class. Why? Because that's where people with money sit. And when they turn to me and ask me what I do, I've got my pitch. Okay, I can deliver that pitch in about 20 seconds. Work on your pitch. Now, When I fly, I also sometimes fly private jet, and that's a whole different situation where I take people with me. So you got your elevator pitch. Okay. Now let's talk about the next thing. We call this your pitch deck. Your pitch deck is your business plan translated into slides. Okay. It's your PowerPoint, it's your deck. And while the business plan tends to be a long narrative of the business intended for one person to really read on their own, which rarely happens, or think of maybe like an executive summary, the pitch deck is what you'll use to present your concept directly to either an individual investor or to a room of investors, to a family office. Maybe you'll do it virtually in a webinar. And the pitch deck is often requested by investors ahead of your meeting or ahead of your presentation so that they can get a good feel for you, so that they can get a quick synopsis on your idea. So be sure to have it prepared and ready to go before you start contacting investors. Okay. And here's the thing, unlike a business plan or unlike an executive summary, which is also a summary of your business, the pitch deck tends to be much more visual, highlighting a few key points, highlighting the advisor team. And it's particularly useful when you're putting together your pitch deck to use graphs, to use pictures, to use visual assets that are going to do a better job of helping you communicate your idea. I've seen some terrible pitch decks where there's a lot of content, it's all wording. Get away from that. Try to reduce the amount of content and put pictures, okay, put graphs that really do a great job of conceptualizing your message. Now let's talk about your private placement memorandum, or what we call your offering circular. This is a very, very important part of delivering that investor package. Now, the point of your private placement memorandum, as the name implies, we call this a prospectus, a memorandum, an offering circular, is to very briefly summarize your business plan into a very formal document, which includes all of the much needed risk disclaimers. You want to point out some of the risks. You want to talk about information on the management team. You want to have what we call an operating agreement that is going to outline how this investment opportunity is going to be managed, what kind of returns you're projecting for the investors, the subscription paperwork, right? So people can actually subscribe and actually make the investment with you. Now, make no mistake about it. It's effectively the sales pitch for your business combined with your pitch deck that is designed to do one thing, and that is to protect you in the course of doing business. Your prospectus, your memorandum, your offering circular is what I refer to as the CYA document. It is the cover your ass document, because not only are you communicating the mechanics of the investment opportunity and how you're going to go about raising money and how you're going to sell the value of your idea, you're disclosing all of the potential risks in this, so that you're covering yourself in the event something happens and things don't work out the way that you think they're going to. So inside the memorandum, you want to discuss a number of key areas. Number one, what's the investment objective? Like, what are you striving to accomplish? Are you investing in real estate? Are you buying a business? Are you doing something like taking an existing business and bringing investors in to accelerate it and to just grow it? Maybe you're looking to bring money in to buy a franchise. You want to open a restaurant, or you want to open something that way. You're also going to have information in there about your key management team. Now, for a lot of you, you're solopreneurs. You're just one person, or maybe you got one person and a small team. What you can do is build out your management team by bringing on advisors. Put your attorney in there. He's a strategic advisor. He's part of your management. Put your CPA in there. You can put me in there. I'm your advisor when it comes to raising capital, but build out your management team. Then you want to have projections on returns. What are the returns to the investor? What's that look like? How much of the profits are you going to share? Then if it's an existing business, you want to share financial information, like what's the health of the company? How much money is the company currently making? And then you want to talk about any type of prior performance or any type of track record that you might have if it's relevant. Now, one thing to note here as it relates to raising capital is basically retaining the services of other people to help you. You say you can hire other people to help you raise money. And one of the things that I want to advise you is that if they're paid a commission or if they're paid a percentage of the amount they raise, the SEC views that as what we call creating an agency relationship, where the other party that's helping you needs to be licensed. So, simply put, make sure you consult with an attorney if you're going to be retaining other people or building a sales team, just to make sure that you're doing things properly. So, let's talk now about the pitch. You've got your offering memorandum, right? You've got your pitch deck, your PowerPoint. Another thing that I also advise is creating a one pager. We sometimes call this an investment summary sheet or highlight sheet. But in most cases, the search for investor support follows a sequence of events. Okay. Think of it like a timeline. Okay. Think of it like a timeline. They're like stops on a subway route or on a train route. And chances are you'll have to stop at each one of these things on your way to get funding, to get an investor. Sometimes you'll have to stop more than once. You'll have to go back. And of course, there are exceptions. You know, a well connected friend might set you up for a meeting. Maybe a family member has decided to give you some money. But, you know, most of the time, you're going to be giving your elevator pitch to a high powered potential investor. And so let's talk about step one. Number one is you've got to identify who your potential investors are. So you compile a list of investors you'd like to work with and that you think are likely to find your offer intriguing. Now, remember this, the more closely the particulars of your company and the investment and the goals match previous investments that an investor has made, the greater your chance of getting their attention. So if you're in real estate, you want to be pitching to people that are largely real estate investors. If you're in software and you're trying to raise money to launch a software company, and here you are pitching a bunch of real estate investors that don't understand the software business, chances are you're not going to be successful. So remember that less is often more. Okay. You're much better off contacting a few carefully chosen investors who are actually a good fit for your business, for your opportunity, than a whole army of potential investors who are going to largely ignore you. So if you're going to go and do real estate, cultivate a list of potential real estate investors. If you're doing software or tech, go to angel or venture capital firms that largely capitalize and invest in tech. You with me there? So the next step is your elevator pitch. Once you've got this list of people that you're going to be approaching, and you can source this list with social media by hosting things on Facebook or LinkedIn or Instagram. But once you're putting together this list, the next step is to reach out to these people with a very concise, well-crafted email. And this is where you introduce yourself and your business, your company. You let the investors know that you have an investment opportunity that they might be interested in, and you invite them to learn more by visiting your site or a crowdfunding profile or a data room, and you provide a link so that they can actually go there and take a look at this. Now, here's what I'll tell you. Many people are scared of reaching out to investors. You can't be scared. You have to be confident, because here's the thing, folks. Many of these investors have their money in CDs. Many of these investors have their money in cash. Many of these investors have their money tied up in investments that are just eking out meager returns. And you've got like this amazing, wonderful opportunity that potentially can get 16, 18, maybe 20+% a year. Like, you've got the golden jewel. Why would you not want to share that with people, right? These people are looking to make money as investors, and you've got a way for them to do that. So step 3 is booking the call, getting to the pitch. Everything you've done so far, putting together your list, researching potential investors, building your website, the preparation of your investor kit, has been with the goal of getting yourself in front of or on the phone or on a Zoom with an investor or a room full of investors to talk about your great idea in more detail. That's it. And if you've managed to spark an investor's interest with everything you've shown them so far, your one pager, your pitch deck, your elevator pitch, this is the point when they'll want to set up a meeting with you. They're going to want to sit down, whether it's a Zoom, whether it's at a Starbucks, whether it's at your office, their office, it don't matter, because the in-person pitch is easily the most important moment you're going to have with this person. Okay. Keep your pitch concise, keep it dynamic, use your pitch deck. These days, it's usually in the form of your PowerPoint presentation, right? That we've just talked about. Keep that minimal, keep it professional, and leave plenty of time in that meeting for that investor or for the investors to ask lots of questions, because more than likely there will be questions. So now you got your appointment. It's on the calendar. You're going to be meeting with, or you're going to be pitching with a prospective investor. And they call it pitching for a reason, because you have to get your proposal over the plate, right? Just like a pitcher in baseball, you have to get your proposal over the plate in order for those investors to take a swing at it. And an investor strike zone is extremely small. So your pitch has to be delivered eloquently. I would recommend you rehearse the pitch before you actually go in and pitch for real money, because your chances of getting your pitch into the sweet spot, okay, into the area where that investor says, yes, I'm going to write a check for you, that chance of getting that pitch into that sweet spot go up significantly when you provide investors with the right kind of information and share with them that right information at the right time. So keep the process moving along on your end. Okay. Investors that are interested are going to be asking questions. And when pitching to a prospective investor or a capital partner or a family office, it's very important to understand the decision to invest is largely emotional. It's like I said yesterday, it's not analytical. That's why you don't need a track record. That's why your age doesn't matter. As long as you exude confidence, in order for you to have success raising capital, you need to appeal to the emotional side of a person's brain. And we do this by focusing on two things. Number one is in your presentation, you need to build to what I call an inflection point in your pitch. And number two is you've got to create FOMO. FOMO is FOMO, and it stands for the fear of missing out. So your presentation should be designed so that it can be delivered in no more than 15 to 20 minutes. And here's what you need to do is you need to think of yourself like the executive producer of a major motion picture. Okay. I always compare and I always use the analogy of raising capital to you being a movie producer, making a major motion picture. You need to build to that big inflection point in the movie where the hero rescues the Harlequin, right? It's the excitement. So as you're building this pitch, think of it as building to a crescendo, building to an inflection point, building to a point where you're going to create that fear of missing out on this wonderful opportunity. And so here are a couple pointers. Number one, tell people why you're different. Tell the investor what it is about you, what it is about your company that sets you apart from other companies and other products and services or other investment opportunities. Tell them why it's a one-of-a-kind opportunity. Okay. Tell them we've got unbeatable customer service. We're best in the industry when it comes to the user interface. The more advantages you can share and name, the more impressive the investment is going to be to them. The second thing, after you tell them why you're different, is you got to talk about your team. This is where you provide the bios of your team's key members, starting with a description of what they do for your company. And this is key. Be sure to highlight past accomplishments that are relevant to your company, your industry, what you're going to be doing to inspire that confidence. Tell the investor that this person over here has had a successful launch before. This person over here has had an impressive number of exits. This person over here has been in the business for the last 10 years. And you want to also talk a little bit about the person's personality. Add a little bit of humor because that never hurt anybody. So you want to basically focus on difference, team, and then you get into what I call the competitive landscape. Here's where you basically are going to step back and name your competition. Now, a lot of you might say, "What? I'm going to be naming my competition?" Yes, you want to look at the top 2 or 3 competitors because that is a very, very good number to go with and provide a breakdown of their position in the market. Talk about the competitive landscape, their strengths, their weaknesses, and here's the key. Then you explain to the investor how your company is positioned to blow those competitors out of the water. So, as an example, if you're trying to raise money to do like a multifamily real estate deal, you want to find a couple of other multifamily companies to talk about. This company over here does this. They've got small little garden style apartments. They don't have anybody on site in the management office. They just had a big sign out front and they get people calling. This company over here, they do this. And then you're going to explain to investors how your company is positioned to blow them, and them out of the water. And that's why I should invest with you. You see? You're positioning your business, your investment opportunity into that competitive landscape because you're competing for capital. The next thing you're going to talk about is what I call the fundraising terms. This is basically a section in the profile or in the pitch deck where you detail the terms of your fundraise, the amount of capital you're seeking to get, the structure of the fundraise, what percentage of profits the investor is going to receive. Is the investor going to get anything in the way of distributions? How is that going to be positioned? Are there valuation caps? Are there triggers? What's the waterfall? You'll also want to provide some information on goals as to the money you're going to raise. Do you have a minimum amount of money? Do you have an escrow? All of these things need to be specific. They need to be detailed. They need to be outlined with percentages whenever possible. Otherwise, it's going to seem to investors that you haven't given this fundraise, you haven't given this offering a lot of thought. And so you want to be very concise in saying, hey, you're going to get 20% profit or you're going to get 80% profit. We're going to basically provide to you quarterly distributions. We're going to take this in management fees. All of these things need to be basically outlined and presented. Now, you heard me earlier talk about FOMO, okay, the fear of missing out. So in the pitch, you want to create a sense of urgency. And we do this with FOMO. It's the fear of missing out. And you can add certain phrases like, we see a window of opportunity in the industry that we perceive is only going to be available for the next 12 to 18 months. So we'd like to capitalize on that while it's still available. Or you might say something like, this opportunity won't be available much longer. So you'd be very wise to explore partnering with us while you can. See, I think you start to get it. You want the prospective investor to be emotionally excited, but also you want to create urgency. You don't want the investor to be sitting back saying, oh shit, I can think about this for the next 6 months and get back to you, can't I? No, like you got to let me know like in the next couple days. You want to get in on this or don't you? Because when you create that fear of missing out and you create that sense of urgency, that's when people are going to call you back in a couple of days and say, hey, Brad, do you still have room for me to get into your deal? And you can then say, sure, how much of the deal would you like to take? Now, let's talk about some mistakes that I see people make. These are what I call the do's and the don'ts, okay? Now you're in front of an investor. You're pitching. It's the finish line that every business owner, every entrepreneur is looking to get across. It's an arduous race. You want to get that check. You want to get that investor's attention. You're now in front and you're pitching. Once you're in the room with the investor, or once you're on a Zoom, or once you're in front of a room full of investors and you're at one end of the conference table, you've got investment partners, it's very important to remember that the hard part is not over. It's just getting started. Okay. But there's a lot of moving parts involved in a live pitch. There's a lot of ducks that you need to have in a row. And I want to talk about these. Number one, be brief and be to the point. Professional investors, people with money, make a lot of decisions and they like to move quickly. Money follows motion. And people that have money are famous for their very short attention span. Right? So, what this means for you is that your pitch is not time for a long winded 45-minute presentation. Your pitch is not the time for a long backstory about your birth, about where you grew up. Keep your presentation literally under 30 minutes. Okay. Better yet, keep it to 20. And then you want to allow a generous amount of time for that Q&A that usually is always going to be there on the back end. The other thing that's very important is to use the industry lingo. Okay. Now, it can be very daunting if you don't have a background in finance or if you don't have a big background in real estate, but you need to use the lingo of the industry or the business that you're in to basically show that potential investor that you understand what you have to offer to them, but you also understand the business that you're in. So study up, okay? Get something where you can Google the common terms, the industry lingo of the business that you're in. And you'll basically then be head and shoulders above many other people that are looking to raise capital as well. The next thing that's very important is don't try to hide the risks. Making investors think that there are no risks or that you have something to hide is a very, very poor way to kick off a business relationship. You want to be open to the risks that are associated with your business, and you want to try to anticipate any of the questions or potential weaknesses that an investor might notice. Don't stop saying what the risks are. You want to basically say, hey, I want to discuss with you a potential risk, but I want to then focus on how we're going to approach that risk, because this kind of transparency in your presentation will show a potential investment partner that you think ahead, that you're a problem solver, and that you have the ability to deal with challenges in the business or in the investment as they arise. And then lastly, and most importantly of all, don't forget your exit strategy. Sometimes entrepreneurs, business owners are so relentlessly focused on looking for capital, they forget that investors are looking for something else, and that is a return on their investment. So when you're pitching to an investor, don't overlook the importance to give them a clear, realistic exit plan. In other words, tell them how the investment is going to come back to them, whether it's in profits, whether it's in distributions, whether it's in a sale, whether it's in an IPO, because a lot of entrepreneurs that start off raising capital forget this very important detail, which seems so tiny to them, but in fact, it's one of the big, huge things that people are looking for that are investors. So, when you're raising money, don't forget to talk about the exit strategy. Don't forget to explain to them our goal is to grow this business and then potentially sell it in 5 to 7 years, or perhaps give consideration to take the company public. And then as you're wrapping things up, as you're getting towards the end of your presentation and your delivery, be clear about what happens next. Because once you've laid the foundation, once you've told investors what you want from them and what you're going to do once they give you their capital, you have to be clear about what happens next. Okay, you have to outline and be very specific about what's going to happen after they invest, what's going to happen with their funds. And investors just not going to give you their money and expect to never hear back from you. So you want to say, after you invest, here's what happens next. You'll get a welcome packet that'll have a welcome letter that will basically memorialize the investment you've made with us. You'll get quarterly newsletters at the end of the year. You'll get your tax reporting information. You got to build the expectation so that they don't have what I call buyer's remorse. Because if they have buyer's remorse and they make an investment and you don't do this concisely and succinctly, they may call you back and say, hey, I'd like to get my money back. I think I made a bad decision here. And that sucks. You don't want to put yourself in a position where you have success and then have to backtrack and potentially refund a prospective investor's capital. So be clear about what happens next. The other thing that's very important is you have to be confident, especially if your company is in the early stages or if it's a startup. Okay. Your pitch may be as much about selling you as it is about selling your company. And the goal of being in front of an investor is to inspire confidence, both in your company and in is you as an entrepreneur, leader, business partner. But there's sometimes a very fine line between being confident and being arrogant. And you definitely don't want to be arrogant. So see all of the things that I discussed if you've been taking notes. And more importantly, listen. Okay. Listen, ask questions. Confidence and your enthusiasm are going to go a long, long way in raising capital. So be confident, listen, ask questions, because those are the things. And most importantly, one last do is get the damn investors excited. At the end of the day, the goal of your in person pitch is to pitch the investors and paint a picture of a business opportunity or an investment opportunity that's simply too good to pass up. You want to combine your powerful ideas with undeniable data, with charts. You want to then throw in the confidence and the creativity with attentiveness and openness. And more importantly, like I said, you want to create that FOMO. You want to create the fear of missing out on something really, really good. So now you've pitched. Now, the next and most important part of all is you got to close the deal. So, a popular metaphor that people tend to use when describing the process of negotiating investments, it's kind of like courtship. It's kind of like wooing a partner or a spouse, right? After that first encounter, the investor is largely deciding, is there ever going to be a second date? So far, you flirted. You've gone on a couple of dates. There seems to be chemistry there. Both sides are ready to take things to the next level. But this is a courtship in the old fashioned sense, meaning you're not just going to run off to Vegas with the girl. That's the money in this scenario. You're going to sit down with the family, which is the investor, and hammer out a careful marriage contract so they sleep soundly at night, knowing their money is well taken care of, knowing that you're going to be a good fiduciary of their capital, knowing that you're going to deliver good returns. So, just like at every stage of the pitching process that we've talked about, there are do's and don'ts when it comes to closing the deal. And if you don't understand the do's and the don'ts of closing the deal, you won't be successful when it comes to raising capital. So, let's talk about close. Focus on the close. Closing the deal with an investor represents the conclusion, okay, of the pitch process. So if you've been pitching to an investor or to an audience in a group of investors, it's largely the close. It's closure is bringing something to a decision, but it's also the beginning of the relationship with that investor. So while it's tempting to rush this process along and gloss over some of the things, you want to basically be absolutely sure that you cover the bases. You want to make sure that you wrap up loose ends. You ask, do you have any remaining questions? And the way that you close is largely by asking them for an investment. The biggest reason many people are unsuccessful raising money is they never ask for the investment. How can you expect to be a successful capital raiser if you never ask for the investment? You have to close. So when I close and I've raised millions of dollars, I always like to give the prospective investor an out. I always like to give them the ability to say no, because there's some psychology behind this approach, and it works like magic. When given the option to say no, most people won't say no. So the close goes something like this. Okay, we've discussed this opportunity in detail, and I've answered most of the questions you've had. How many units in our offering would you like? Would you like 1 unit, 2 units, 3 units, or no units. And the next step is very important. After you say no units, you literally need to bite your lip and not say another word. Let that prospective investor think. Allow that discussion that you've just had, that pitch, to sink in as their mind is thinking. You've tapped into the emotional side of their brain. You've built to your inflection point. You've delivered FOMO. And many times they're going to come back and say, tell me again, Brad, how much 2 units in your program cost? And that's the point where you smile, you sit back, you let them know that the subscription paperwork was included in the package, and you say, let's get the paperwork and subscription process started. I'd like to show you how to fill everything out to make sure you do it properly. I'd like to welcome you aboard. You see, when you give the out and you say, how many units or how many shares would you like? 1 unit, 2 units, 3 units, or no units. They very rarely say no units. They'll usually say, yeah, let me take a unit. Let me take 25,000 bucks with you. Let me get started with that. They may say, do you have room for me to come in for 4 or 5? And while you may have room for them to write a larger check, I found through experience that sometimes they're testing you. And so what you want to do is say, let me check. Let me put you on hold, or let me go make sure we still have enough in our offering or in this investment available to give you a larger subscription. Because a lot of times they're testing you. And if they say, look, I'd like to write you a check for $250,000, it's sometimes better to say, I can't take that, but I can take 200. See, now you've earned their trust. Now you come across as a person of honesty and a person that they're going to invest with continually over and over and over again. You're not coming across as this money hungry person that's just going to take every penny you can grab. So sometimes remember that investors are testing you. Lastly, as we wrap this up, I want to talk about rushing the process. One of the biggest mistakes I see people make when they try to raise money is they rush the process. You got to understand, nobody's going to invest with you until you establish that trust. And I talked about this yesterday, The Trust Economy, the wonderful book by Philippe DeConner, where he outlines this trust process. You see, and when the deals are closed and the papers are signed and the money is in the bank, you may think it's time to put your feet up, relax, congratulate yourself on a job well done, but nothing could be further from the truth. Now that you have an investor, now that you have a capital partner, it's time to put the money to work, because investors want to see the good their money is doing for your company. They want to see how the investment is performing. And if you do a good job and you're transparent and you've sold your investors properly, guess what? They're going to refer you to other people. They're going to refer you to their golf partners, to their country club buddies, to their neighbors, to their business colleagues, because that's what investors do. And so I want to basically just wrap this up and say, I've enjoyed speaking on this subject at the High Performance Success Summit. For any of you that would like to learn how to raise money successfully, you can go to Amazon. You can find my book there called Winning at the Capital Game. I highly recommend that you get a copy of this, where I really go into depth on how to successfully raise capital. I break it down. I basically outline it, and I summarize a lot of the things that I discussed here today. For those of you that would like to be mentored and perhaps coached on how to attract, how to raise, how to close investor capital, we have an entire coaching and mentorship program that's built around this. You can basically send an email to our team. We'll schedule a strategy call with you to see if we're in alignment, to see if what we do makes sense. And we'd love to have you as one of our global students so that we can teach you and mentor you how to attract, how to raise, how to close investor capital, how to get into real estate, how to buy businesses. That email address that you're going to send this to is info, I-N-F-O, at bradblazar.com. My last name is spelled B-L-A-Z-A-R, info at Blazar.com. Just say you're interested in scheduling a strategy call with us, and perhaps myself or a member of my team will get on. We'll find out what you're interested in doing, and then we'll talk about helping you bridge the gap to get you from where you are to where you want to be. Jason, thank you so much. We're at the top of the hour. It's been great speaking again on raising capital and putting together your pitch deck. Everybody have a wonderful remainder today, the High Performance Success Summit. I've enjoyed spending time with y'all. Just remember, be well, continue to hustle and grind, and more importantly, just stay focused on your goals, everybody.
Thank you so much, Brad.